What's pushing oil prices, growth forecasts, and business confidence to extremes? Here's what's happening, and why it matters to you. Here's a look at the key financial stories shaping your world today. First, OPEC Plus is reportedly considering an increase in oil supply at its next meeting. This move, aimed at stabilizing volatile markets, could potentially bring down global crude prices and offer some relief for consumers at the pump. In Germany, there's a note of cautious optimism. The government has slightly raised its economic growth forecast, pointing to a modest recovery in industrial activity and improved domestic demand. Stateside, whispers of an earlier-than-expected rate cut from the Federal Reserve are growing louder. Softer inflation figures are fueling hopes for a policy pivot that could stimulate the economy. However, challenges remain. The Eurozone's unemployment rate has ticked up slightly, while in the UK, business confidence has slumped to a new low amid ongoing economic headwinds and high borrowing costs. The global oil market's equilibrium remains a key focus, hinging on OPEC Plus supply discipline. The consortium's extended production cuts aim to keep Brent crude prices firm, creating a floor under the market. On the demand side, resilience from recovering global travel and steady industrial use prevents a price collapse. This tight balance has direct consequences. Higher crude feeds into headline inflation, complicating the mission of central banks. For households, it means sustained pressure on energy budgets, which can dampen consumer spending and cloud the overall economic outlook. This dynamic forces policymakers to walk a tightrope between controlling inflation and avoiding an economic slowdown. Europe's economy is navigating headwinds. The manufacturing sector, especially in Germany's industrial core, remains weak, with PMI data consistently signaling contraction. A key factor is elevated energy costs. The shift to more expensive LNG has embedded a higher cost base for industry, hurting global competitiveness and leading to soft export performance. Amidst this, Germany's slightly upgraded growth forecast offers a glimmer of hope. However, this optimism is based on a potential rebound in domestic services, not an industrial revival. It highlights a challenging structural transition for the continent's largest economy, as it grapples with new economic realities post-energy crisis. All eyes are on the world's major central banks. In the US, the Federal Reserve remains data-dependent, signaling that the timing for rate cuts is not set in stone. Officials need sustained evidence of cooling inflation before acting. The European Central Bank faces a tougher trade-off between a stagnant economy and sticky services inflation, making its decision path complex. Similarly, the Bank of England confronts the UK's uniquely persistent inflation and wage pressures. This potential for policy divergence, where central banks move at different speeds, is a major focus for currency markets, creating uncertainty for the dollar, euro, and pound. A critical data point for the ECB is the labor market. A recent, albeit small, uptick in the Eurozone unemployment rate suggests that historic labor tightness may be easing. For policymakers, this is a welcome sign. A cooler labor market implies that the wage pressures fueling services inflation could begin to moderate. This development is crucial, as it gives the ECB more confidence that inflation is on a sustainable path back to its target. It strengthens the case for beginning to lower interest rates in the coming months, providing much-needed relief to the sluggish Eurozone economy without risking a resurgence in price pressures. In the United Kingdom, corporate sentiment is decidedly downbeat. Business confidence has slumped, leading to a tangible slowdown in capital expenditure. Firms are delaying crucial investments in new equipment and technology due to a fog of uncertainty surrounding future costs, interest rates, and consumer demand. This has triggered a defensive shift in strategy. Instead of investing for growth, companies are hoarding cash and avoiding long-term commitments. This liquidity preference is a rational response to risk, but it starves the economy of the investment needed for long-term productivity and growth, creating a holding pattern of caution until the outlook becomes clearer. For households, the impact is direct. Volatile energy costs drive up monthly bills and prices at the pump, squeezing disposable income. Persistent inflation then erodes the real value of wages. If paychecks don't keep pace, purchasing power for groceries and essentials falls. On top of this, central bank rate moves reset the cost of borrowing. This means mortgages, car loans, and credit card debt can all become more expensive, tightening the financial pressure on families. For businesses, this environment is a high-stakes balancing act. Economic uncertainty clouds demand visibility, making it difficult to forecast sales as consumers pull back. This uncertainty causes companies to delay expansion and new projects, stalling growth. At the same time, rising borrowing costs make it more expensive to fund operations and innovation. These factors converge to squeeze profit margins, directly influencing their capacity for hiring and future investment, creating a cautious corporate landscape. In the best-case scenario, oil prices stabilize, providing relief and cooling inflation. Seeing this progress, central banks can begin to cautiously cut interest rates, a managed pivot to achieve the coveted soft landing. The result is that growth muddles through, avoiding recession. It's not a boom, but a mild expansion where unemployment remains low, spending holds steady, and business confidence gradually returns. This is the path of steady, albeit slow, recovery. Conversely, the worst-case scenario is a perfect storm. It could be triggered by new supply shocks, like a geopolitical flare-up, sending energy prices spiraling again. This could be compounded by a major policy misstep, where central banks either keep rates too high for too long, crushing the economy, or cut too soon, letting inflation become entrenched. This toxic mix would cause a broad slowdown to tip into a painful recession, marked by rising unemployment and a collapse in confidence. Which of these trends worries you most? Comment below.